Welcome to Morningstar. I'm Larissa Fernand, and with me today is Samir Arora, the founder of Helios Capital. Samir, thank you so much for giving me time today.
Not at all. Thank you.
Okay, so let's dig right in. My first question to you, Samir, is way back when you were running Alliance funds, you took some really concentrated bets based on your conviction, and you were really shooting out the lights. But now you talk a lot about diversification. So, can you tell me what it is you believe today that you did not believe then? How have you evolved as an investor?
So actually, it is not true that we were taking very concentrated bets because I was a mutual fund manager, and the rules are that you cannot have more than 10% in a stock. And then in the offshore fund that I was managing, which is Luxembourg based, the rule, if I remember, is that 10% in one stock and cumulative 40% in stocks where your weight is more than 5%. I think the difference is that I am now articulating better. That time I was doing it like normal guys that we are buying some 30 stocks. And now I found a logical reason to say why you should own, why you don't have to own 10, 15 stocks. So if you say concentrated in for many funds might be 30, 40 might be concentrated. We consider that as reasonably diversified. So those days were great, of course, Alliance days. And the simpler way of making money in those days was to ignore all the existing companies and go for only new companies. That is because the existing companies which had grown by protection and under government rules, then the government said that no longer will there be protection, but in exchange you will get freedom to do whatever, expand capacity, hire, etc. And so the money there was different because there were new themes coming up related to opening of media sector and IT sector and private sector banks, and those were the early days. So the difference now when I say about diversification is I'm saying that broadly you don't need 10, 15 stocks, but you can have even 30, 40, 50 stocks. Basically, because I realized over the years that we are as fund managers not able to get even the performance of the 150th best stock, broadly speaking, of the index. That means the top one-third stocks do so well that there is no need to concentrate. And the second thing I've realized is that by definition, concentration does not work. For example, if there are only, say, 50 people who concentrate, so when the rest of the people are all dumb and don't know what they are doing, and only the concentrated guys know what they are doing, then even then these 50 guys are owning, say, 10 stocks each. And some stocks may be common, let's say. But then these guys are cumulatively owning, say, 300 stocks if they have 5, 6 unique stocks and some common with others. So this group of knowledgeable people are owning 300 stocks. So if I own from those 300 stocks, 30, 40 stocks, how does it show that I can't do well, but these 50 guys will do well? And second is a more practical reason that normally no investor has the guts to give all their money to one concentrated fund manager. So if an investor buys 3 concentrated funds, now is he, because he now owns 30 stocks, which is what I say he should have. So how will he do better just because he has 10 stock pools? So broadly, I think concentration only works that somebody who got his 10 stocks right is a hero. And the guys who don't get any right or many of them wrong, basically you don't interview them. So there is just a lottery.
So there's a difference in your own portfolio. Do you take a lot of risks? Do you take concentrated bets? Because when with your money, it's skin in the game and you pay the price for your conviction. In a fiduciary capacity, somebody else pays the price for your conviction. So how do you deal with it psychologically and practically?
With my own money, that way. Sorry. So first thing is that we don't invest on our own. I am the number one largest investor in the offshore fund. And unless some big guys come, most probably I'll be the largest guy, at least initially in the mutual fund. And so the point is that I really believe it myself that owning 30, 40 stocks lets you, because people assume that the 30th or the 35th stock is worsening your portfolio by calling it diversify kind of thing. The reality is that since only in 2 years out of 18, I have been, as a fund manager, able to get even the performance that the 150th stock got in the market. And I claim that I am one of the best in India relative to everybody else. So broadly, zero fund managers, according to me, big picture, maybe once in a while somebody has got the performance that the 150th stock delivered, which means that the stocks that the 20th stock that you buy might be actually a big winner, or the 30th stock. There is no this thing that the highest conviction is the best stock. For example, in terms of performance, for example, our number one holding is HDFC Bank now. It does not mean that we expect the highest possible return from HDFC Bank. It is that there are two kinds of stocks in anybody's portfolio. Some stocks you have very high confidence that they will give reasonable return. Reasonable means better than the market, hopefully by some 3-4%, but they are not going up 30-40%. And then there are smaller, sort of newer, or stocks that have just got listed, or old stocks that got hit a lot. But you cannot have the courage to buy 10% in those like we have in HDFC Bank. So there you're buying 2-3%. It is very logical for an individual to invest like that and a fund to invest like that. The other thing is that in the end, you are not appealing to 100% of the audience. The investors will realize that these guys are conservative, that these guys are aggressive, that these guys are ultra small cap, that these guys are macro driven, and the investor will choose. Our story is that we are consistent, and consistency has made us nearly at the top. So our tagline for our fund will be "हर term के लिए," not long term. "हर term के लिए" means a long term is a series of 1 to 3 year type periods. And if you keep doing well and analyzing like that, you can hold a stock also for a long time, but you can't go in thinking that I have discovered this stock for 10 and 20 years, because it is my belief that the management also does not know that their company is so good. And quickly, I can give an example that when Steve Jobs died in 2011, his number one stock was not Apple. He owned 6 billion or so of Walt Disney, which he had got for selling Pixar. And he didn't really have any Apple. He had just got some ESOPs. So why didn't he know in 2011 that, I am sitting in a company which is going to go and compound at this rate, that rate, and why don't I switch my Disney to Apple? Because nobody knows. And I can give many more depending on the time that you have, that nobody knows anything as to even the good guys, how they will evolve and will they take advantage. For example, Aditya Puri was worked in a Citibank, and therefore can be said that he created or helped HDFC Bank grow. Rana Kapoor was sitting on the same thing. He had come from a foreign bank. He was one of the first individuals to get a license. But his inner motivation, his craziness, his stupidity, how would you have known in the beginning? You would have thought he's a next HDFC Bank in the making. And actually, he had a better this thing, that he had got a license, or 2-3 professionals had got a license, which never before anybody had got. Even Uday Kotak was actually a company or a brokerage or whatever they were as Kotak Securities. Rana Kapoor and his other Kapoor, Ashok Kapoor and all, were just 3 employees or individuals. So on that day, you would have assumed that. So nobody knows these things beyond a point.
Okay. Yeah. So taking off from this point where you're talking of promoters, you said that one book that really impacted you was Would You Kill the Fat Man? So it talks about morality, ethics, what's right, what's wrong, philosophy. Are there any red flags you would see in a promoter which would make you say, just run away? Or if you've already invested in the company and the red flag comes up, would you be willing to say, I'm walking out?
Well, many times we have walked out. But before that, so this book, I tweeted about it, but not so much in the context of my investing. But if you want to take that book as an example, the story there is that if you're 4 men tied up on one side of a track, and on the other side there's one fat man, will you change the course of a train to kill one man instead and save 4 lives? Which means you are still doing something wrong, or you're still killing somebody, but you are preventing 4 being killed instead of 1. So if you take it like that, the point is that if you want to really argue about ethics, I can prove that nearly everybody has some
Agreed.
issue. It could be he has taken ESOPs. It could be that they have this. So you can't overdo it. So
Yeah.
the things that we would do in our Indian context is, number one, I didn't like in the past serial issuers of stocks for themselves via these warrant issues. In fact, some of the worst companies that I identified because of that, and they've done very badly, were companies where they did warrants to themselves, then the stock fell, and therefore they did not give the balance money, which previously used to be 90%. And 1 week or 2 weeks or 1 month later, they again issued new warrants to themselves at the lower price because of 2008 prices had fallen. There was another high profile company, later on offline, I can tell you the name, where they announced some big deal on Friday and issued a warrants on Sunday. So the stock, technically the inside news was out, but the stock had not opened. So therefore, you get those 15-day average. These are in your face kind of things which make you more angry than anything else. Now, in terms of other things, whether his accounting was good or not good is more some issues we feel like if somebody changes the revenue, because many people in the, in the 90s and even maybe not now, but recently we have seen where they effectively bought revenue. Forget about other things. Now that is too blatant and nobody can tolerate. But if somebody says, I write off my assets over 5 years and somebody says 7 years, you can adjust for it, but not really take it. Or if somebody says that my FX, I am putting in the P&L and somebody takes it to balance sheet, that as our analysts and we decide whether it is so egregious that we will never touch. And one more thing, which if I think of examples, is where I got to know that a group of companies were effectively rigging the other companies in that group, not their own. Because in their own, it would have been called insider trading. So let's say company A says, I will change the price of B and B will change the price of C, or supported with similar amounts. And these blatant things, not only, of course, that time we didn't buy it, but 10 years later, some of these stocks have gone up 10 and 20 times, and in our life, we will not buy. And those names, the guys who are hearing me know that it was their stock. They can hear of this. But point is, if it is too blatant, you have to remember it forever. Then you can't say 10 years have passed and now they are okay, or the stock is currently in favor for ABC reason. So there are many issues. It depends on, there's a confluence of factors at that time, what makes you deeply upset. And some make you upset and some you say, let it be. But the good thing is, in theory, you can be as strict as you want. Because remember, 150 stocks do well. If you reject some company on the basis that it doesn't gel with you what they do, and that stock does well, mostly it is not taking away your opportunity set to such a big extent. Because anyway, 150 companies do well. We broadly know that the 150th stock, if we had, it adds value to our NAV because our NAV is lower than the 150th for literally everybody in the industry. So you can reject as many as you want.
Okay, so another book of yours which you like is The Halo Effect. And the halo effect is when the stellar financial performance is so good that one attributes its golden glow to all other, to strategy and to execution. Have you ever found yourself being a victim of this, or what do you do to protect yourself from this bias?
So, by the way, this book is really one of the best books I've read in finance. I would have read it 3 times. So, unlike the Will You Kill the Fat Man is more a philosophy book, and but this book is really, really good. It would be, when anybody asks me which are the best books to read, it is one of them. So here we have been victims in the sense that in the beginning I might have been, but last 10, 12 years I have not been of these things. And many of the stocks which are currently or in the last 2 years viewed as all-time great companies and trading at 70 multiple, and many fund managers making full funds out of these stocks. Broadly, we have not had any of them or many of them. And the thing is, now once you understand the concept, you will not be a victim. You will be a victim if you don't first understand this concept. But after reading this book, you can't forget it, that this has to be differentiated. that are you calling everything good because the price is good? Please remember, at any point of time, some 20 stocks would have done well, or 30 stocks. The question is that if they did well for 20 years, did 20 years ago, how many stocks were there from which these 20 would have been chosen, or how would you have arrived at this 20? It's like this, that at all times, somebody would have predicted the market as going up and some would have predicted it going down. And therefore, all the guys who would have predicted it going up are heroes for that round. Now, if 50% of the people get it right, and now you ask that 50%, okay, let's predict for the next round, then again, half will get it right. So the first fellow would have got it right for 2 consecutive periods. And then again, you ask for the third round. So by definition, somebody would have been right for 7, 8, 10, 20 rounds. It doesn't mean anything. If a company's results are good, they could be result for many things beyond just them doing well. It could be when they started, the valuations were low. It could be that when the period that you're looking at that time, the competition was less. It could be that at this period, the growth was high. It has no beyond a point connection that it is now set for life. That's the basic thing.
Okay, then is there any bias that you are susceptible to? How do you protect yourself from that bias? Is there any bias you're aware of, any cognitive bias?
So broadly, because we believe a little bit in diversification and we also believe in covering our angles, which means we don't want our portfolio to be all growth or all value. So in that sense, if you say my bias could be that I don't believe in companies where government is the customer. But it's not a bias. I have been hit again and again and again and again for 20 years on stocks which I bought on the basis that they have got some order from somebody, either railways or this or that or road or water. And in the end, they don't get paid. Now, suddenly, if the government changes means their behavior changes and they start doing it on time and pay on time. It's not a bias, but I'm saying these are the experiences we've had, which you can say now we are biased against these kind of sectors and industries. But behaviorally, since my main story is that I believe more in what I don't own, that I should not own them. And what I own is the residual. I don't have much of this thing on what I own. I can sell it in 30 seconds and not feel bad because my conviction was on the other side in what I didn't own.
There's this tired and very worn out cliche that the market keeps everybody humble and it's a great leveler. What has dealt a blow to your pride as a money manager that made you a more astute manager?
So that way, over the years, every mistake we have made, from buying companies where we were looking at P and not at balance sheet in the beginning, we have bought companies where in the end it turned out that the revenue was fraud. We have bought companies like Amitabh Bachchan, which went to zero. There have been every mistake has been made, and but to survive for 27 years, I found one thing, which is that if I look at each company separately every day, or 30 companies or whatever, 40 companies, then I cannot survive for so long. The survival works, hey, my portfolio did well. And in that one company did very badly, but that is how the rule is. The rule is that some companies will do very badly. I have accepted it. For example, when I say that 150 companies do very well, in our presentation, we also show that 150 do very badly. That is how you get the average. Basically, half the companies beat the index, half get beaten over 2-3 year period. Why it doesn't happen over longer period is because the index itself changes, so it becomes very confusing. Otherwise, it would have been true for any period that it's an average of return of these companies. Sometimes it'll be a little less because large companies did better, and then next year the broader market will do better, so the number of companies that beat the index will be more. And because half are beating and half being beaten, 1/3 are beating it more, and on the other side, 1/3 are being really beaten. So if I own 40 stocks, according to the big picture formula or this thing, 12 stocks are anyway going to do well without your effort. And 12 stocks will do very badly because 30% do badly. Now, because we do research and we have 14 guys and we have this experience, we are thinking that our 12 bad, if it can become 6 bad, you cannot have 0 bad. And when we mean bad, we mean really bad. Means 30% away from the index. Like last year, the market was up 4% calendar year. In that same market, there were stocks like Varun Beverage up 100%, Indian Hotels up 70%, some Adani. I'm not about what I own, I'm saying generally in the market. Some ITC up 50, how much, whatever percent. On the other side was Gland Pharma down 59%, and Piramal down 40%, and Quest down 35%, and L&T Tech down 40% in the same market, where the average of all this is 4%. So you can't say, oh, I got, which I didn't get Gland, by the way, I had Piramal. Oh, Piramal is down 40. You are going to get some of them you cannot avoid, but it should be much less than the proportion and you will outperform. So I have survived without feeling bad on any one of them on two grounds. One, that I have to see my portfolio and not, because we are normally long 35, 40 stocks, short 20 stocks. Now, there are 60 things moving every day. I can't say to myself or to the team, oh, why did this stock go down? They'll say, why are you talking about this stock? You didn't tell us about the R10 stocks that are up so much today. So we forget about it. Portfolio. And the second thing is, over the years, I've realized that 30% have to do badly. I must get, say, I don't know, we try for whatever, but that 10% can do badly. What that is part of life, and you'll still outperform, because either you save on the stocks that do badly, or you get more of the stocks that do well, or otherwise you'll get them around the index. So they'll be like break even relative to index, which sometimes you will get some of those, which is also okay as long as they don't, take away your performance. So we are doing everything stats wise in that sense.
What gives you sleepless nights? And I don't mean just investing, generally. Does anything give you sleepless nights?
Even in 2008, I used to sleep. I recently read a book which says that you should be able to sleep 8 hours. I have been able to sleep 8 hours all my life. So I don't. Now, many people, say when they're selling their fund that, I am invested in my fund. And therefore, but your pain, and as you asked correctly, that whether your risk tolerance, this thing is the same as the investor. So I can sleep, whether my investor can sleep or not, he has to see my performance and decide. But I am not taking risk separately for myself versus the thing. So I feel they should also be able to sleep with this kind of model. But in 2008, I used to sleep even then, even though that was an absolute bad year for everybody and so many redemptions were there. But that might be just because over the years I've been hardened that the bad years don't last, because in a market, 7 years are good, 1 year is bad. And then again, it's the same cycle. And if you don't leave the market, you may leave the stocks and you, in fact, add. That's how I become the number one, because I added and others left. So that is how life is.
And would you consider that lucky?
Oh, I'm definitely lucky. But, if you read these books on luck and all, people say that Warren Buffett could also theoretically be lucky. For example, recently one guy in India has written a book. Now, he himself says that in his life, he's bought 20 stocks. So if 10 of them turned out to be good, what does that mean? Nothing. It could be that he got 3 extra stocks by being lucky. But you do it over 27 years, you buy 40 stocks at a time, the luck factor would have evened out. So Nassim Nicholas Taleb says Soros cannot be lucky, but Warren Buffett could be lucky, because he himself is saying he had 12 successful decisions and that changed his life. So if you make fewer decisions, since in our business, it's a right wrong, you can't randomly with luck write a book. You can't randomly with luck compose music. But randomly with luck, you can be right or wrong in business. And if you get 4 in a row, which depending on how many people start, somebody will get. If 1 million people play investing game, first round, some 500,000 will be right if it's a decision of buy or not buy. Then from those 500, 250,000 will be right second round, buy or not buy. So 250,000 would have 2 rights in a row. And then you 125,000 and then 62,000. So after 5 rounds, some 30,000 people will say that we made 5 consecutive correct decisions on the market or on some stock. So even in the end, after 15 decisions have been made, some 40 people will say, I got 10 in a row, I'm a hero. But you make hundreds of decisions, the numbers have to go down. So since I've made hundreds of decisions, could be that luck has played a less role, but overall I am lucky.
What makes you insecure?
I don't know, never thought of it because nothing, I don't know. I feel okay in life, so I don't know. You're being too deep. I have never
Okay,
had to
let me
think so
ask.
much simply because, broadly life has been good. So never went deeper into this.
Okay, then what is a strength? What do you honestly say is your strength as a money manager?
So my strength as a money manager, I would think, is that I am dispassionate. For example, I have gone from being long a stock to in the same day being short a stock after owning the long side for 10 years. I don't want to tell the stock here, but this happened in the last 2 years. I have in 27 years, for 7, 8 years, I was India's #1 biggest mutual fund manager among all the new companies. I mean, all the new, not the UTI and the State Bank at that time, who were the incumbents and were biggest, but including HDFC and ICICI and Templeton. I was the #1 biggest. And actually, more or less in 27 years, I would not have had a meal with a promoter on my own. 111. Reason being, I want to be able to sell when I feel like selling and not feel that yesterday I had meal with him and he gave me a big story and next morning I knocked it off. We were trying to do one fund and we had an advisory board. And then that fund never took off. So technically they were not on the advisory board because they were supposed to be on the advisory board of a fund which I would have started. And I shorted their stocks about 6 months later when 2008 came, not saying, oh, this fellow was supposed to be on my advisory board, therefore he agreed to help me or something, or lend me his name. Behind me, you can see here, behind the two Ganesh, with the two Ganesh, there is NAV. NAV is my God, you can say, or guru or whatever. That is my boss. So, and I really, as a money manager, I think, because I don't think of it as a job. And I feel very unimpressed with fund managers who, from a distance, I feel are doing a job. So I'll tell you one story, big picture. There was an interview with the CIO of an Indian mutual fund many years ago, and they said, where do you invest? He says, I don't invest in equities because my whole business is related to equities. So I am anyway connected with equities because when equities do well, our AUMs do well. This was before the time SEBI said that you must invest in your own funds. But these kind of guys, I don't like these kind of guys. This is not a job. This is too much fun and too much responsibility, and in that sense, pressure, but not something that I myself don't do it because, anyway, I am going to benefit of it.
So you find your job fun, but I mean, you enjoy it. But at the same time, you can be very dispassionate, right?
I am ruthless. I don't see, I always say, people say that we have to, you are aligned with the promoter. I am not aligned with it. Because my whole advantage over the promoter is that I can walk out. And promoter, for not being allowed to walk out, has private gain. He can take ESOPs, he can do warrant issues, he can take salaries. Maybe he has his own travel agency, which does the business of that company. My whole strength is that I will come, when I'm coming in, I don't owe you anything. And when I'm going out, I owe you nothing. You are not giving, I don't want your QIPs, I don't want your anchor allocations. I am buying on the screen and I will sell. But I have had many stocks for 10 and 20 years. Like I hold HDFC Bank for 28 years, both personally and in our fund, literally every day. Literally means actually every day, from Alliance days to now. Even now it's our #1 holding. The stock hasn't done anything. That is okay. But I don't owe them anything and they owe me nothing. So therefore, you can say we are aligned. Obviously, if the stock does well, they will also benefit and I will also benefit. But if I have to sell, I am not calling anybody to say that, I'm so sorry that after 20 years, I have to go and do this. But because my job, I actually owe it only to investors.
So are you excited about your mutual fund?
Super excited, simply because in the Alliance days, we were one of the few 100% foreign owned AMCs. And because it was 100% foreign owned, I got an early stage high responsibility because there was no local fellow to say, I know more than you kind of thing. And we were competing with all these guys who were big India position means known in India, like HDFC, ICICI, or Heja, Sulgaonkar, Birla. And they also had similar as us foreign partners, which was, Standard Life or Pru or Templeton or whoever, And I became India's biggest fund manager, and we became India's biggest mutual fund company. I want to do it one more time. Not that to become the biggest now, because their lead is too much, but that whole period of going to 20 cities and doing road shows and meeting thousands of people, I like that. I'm a people's guy. I like it.
Then I certainly wish you luck in that.
Thank you very much. Thank you.
I think that's about it. Thank you so much for your time,
Thank you
Samir.
very
It really was great chatting with you.
Thank you very much. Thanks.
Thank you. Bye.